Every few days, another video tells you there is money out there for Canadian seniors. Great news, they say, new benefits, extra cash. And then comes the little phrase that ruins the whole thing. If you qualify for modest income seniors, for those who are eligible, and they never ever tell you the actual number. So you sit there, 70 years old, doing the honest thing, trying to work out if they mean you, and nobody will just say the line out loud. Today, I am going to say every one of those lines out loud. Because here is the truth. Almost nobody in this space will admit to you. Every single one of these senior benefits, the guaranteed income supplement, the GST credit, the dental plan, the clawback on your old age security, is decided by one thing, a number, your income, measured against a specific dollar line the government has already drawn. You are either a dollar under that line and the money is yours, or you are a dollar over it and you get nothing. And most seniors have no idea which side of the line they are actually standing on. They guess and they guess wrong in both directions. Some leave money sitting there unclaimed for years because they assumed they earned too much, and others count on a benefit that a small raise or a pension bump quietly pushed them out of. So here is what I am going to do today, and I'm going to be completely straight with you because I know that is exactly what you are tired of not getting. I am going to walk you through the 5 income lines that decide almost everything for a Canadian senior in 2026. The exact dollar figure for each one, who is under it, who is over it, and this matters what you can still get. If you are one of the people who sits just above the line and feels like the system forgot you, by the end you will be able to place yourself on every single one of these in about 60 seconds. And you will never have to sit through another if you qualify again without knowing exactly what it means for you. And stay with me right to the end, because there is one line, the 4th one, that works completely backwards from the others. On the first 3, being under the line is good news. On that one, crossing the line quietly starts taking your pension away at 15 cents on every dollar, and your statement never shows you it is happening. If you have any kind of private pension or RRSP income, that is the one that can catch you, and I do not want you to miss it. Now, my name is Dr. Elizabeth Thorne. Quick and honest introduction. At our agency, Smart Retirement, we spent years inside the world of Canadian retirement tax and benefits, reading the fine print on what Ottawa and the Canada Revenue Agency are doing with your money, so you do not have to. And before we get into it, do me one quick favor. If you or someone you love is on OAS or GIS or is about to be, hit the subscribe button and give this a like, because it genuinely helps me get these exact numbers in front of the seniors who need them. And tell me your province down in the comments, because a few of these have a provincial layer on top, and I read every one. And before we start, one quick thing about why you have never simply been handed these numbers because it matters. It is not an accident. The government does not print your GIS cutoff on your OAS statement. The whole system is built so that you have to already know the benefit exists, know the number, and go and ask. The result is that billions of dollars in benefits go unclaimed in this country every year because nobody ever told them the line. That is the entire problem this video exists to fix. So let us fix it. All right, let us draw the first line. Number 1, the guaranteed income supplement, the GIS. This is the big monthly top up on top of your old age security for lower income seniors. So here is the actual line as of the summer of 2026. If you are a single, widowed, or divorced senior, the income cutoff to qualify for the GIS is $22,512 a year. And this is the part people miss. That is your income, not counting your OAS pension. So a single senior can have a small pension, a bit of interest, some CPP, and still be under that line and still get a GIS top-up worth over $1,100 a month. Now, if you have a spouse or a common law partner, the line moves. If you are a couple and you both receive the full OAS, your combined income has to be under $29,712. But if you are a couple and your spouse does not get OAS at all, your combined cutoff jumps all the way up to $53,094. A lot of couples assume they earn far too much to qualify when they are actually sitting comfortably underneath the line and leaving money on the table every month. Do not disqualify yourself in your head. Do the arithmetic, and if you are anywhere near that line, make the call to Service Canada, because it is only paid back so far. Number 2, the GST credit. Except as of this month, it has been renamed the Canada Groceries and Essentials Benefit. Same tax-free quarterly payment landing in your account 4 times a year. The phase-out begins at $45,521 of adjusted family net income. That starting line is the same whether you are single or a couple. Under that number, you are getting the full amount. Above it, the credit shrinks by 5 cents for every dollar you go over until it finally runs out, somewhere around $56,000 for a single senior. So this is a benefit that reaches a lot further up the income ladder than the GIS does. If you have been assuming you make too much for any of this, that assumption may already be costing you. Number 3, the dental plan, the Canadian Dental Care Plan. The word free gets thrown around and the reality is more complicated. The hard wall is $90,000. If your adjusted family net income is $90,000 or more, you do not qualify for the dental plan at all. Underneath that wall where you land decides how much you actually pay out of your own pocket. If your family income is under $70,000, the plan covers 100% at the plan's fee guide. Between $70,000 and $80,000, the plan covers 60% and you cover the other 40%. And between $80,000 and $90,000, the plan covers 40% and you are responsible for 60% of the cost yourself. Even in the full coverage tier, the plan pays according to its own fee guide, and if your dentist charges more, you can still owe the difference. Go in knowing your tier and asking your dentist before the appointment whether they are billing above the guide. That one question saves people a nasty surprise. Remember, your eligibility for the 2026 benefit year is based on your 2025 tax return, which is exactly why filing on time matters so much. This is exactly why I put a free one-page version of all of these lines in a single sheet down in the description in the pinned comment. It is called the Smart Retirement Money Playbook. Grab that and let us keep going. Number 4, the one that runs backwards, the Old Age Security Clawback. Once your individual net income climbs past $95,323 in 2026, the government begins clawing your OAS back at 15 cents for every single dollar you are over that line. It is calculated automatically off your tax return, and it just quietly reduces your OAS payments without any warning letter. This is the line that matters most for the saver who did everything right, who has a workplace pension and an RRSP, because those withdrawals can add up past that line faster than people expect. The good news is this is the most controllable line of all of them. If you can see the line coming, you can time your withdrawals, use your TFSAs, and split your income around it instead of walking into it blind. Number 5, the allowance and the allowance for the survivor. If you are between 60 and 64 years old, too young for your own OAS, and your income is low, and either your spouse receives the GIS or your spouse has passed away, there is a monthly tax-free payment waiting for you to bridge those years until 65. For a survivor in that age band, the maximum is over $1,600 a month, and the income to qualify sits around $30,000 a year. If you or someone you love is in that exact window, please do not let that one go unclaimed. Now, there is one trap that ties all of these lines together, the one-time withdrawal. You pull, say, $18,000 out of your RRSP or your RRIF to cover a home repair. On your tax return, that $18,000 is added to your income for the year. That one withdrawal can push you over the GIS line, push you over the grocery credit line, and bump you up a tier on the dental plan. One withdrawal and you have quietly knocked yourself over 3 lines at once. So if you ever have to take a big lump sum out of a registered account, spread it across 2 calendar years instead of 1, or plan it for a year, you are already over the lines anyway, so it does not drag you across them. Nobody warns seniors about this, and it is one of the most expensive mistakes in the whole system. What if you have not filed your taxes in years? Almost all of these benefits are triggered by your tax return. No return, no benefit, no matter how low your income is. Filing those missing returns can open the door, not just going forward, but often to money owed retroactively for the past as well. Filing is not the thing to be afraid of. Not filing is what has been quietly costing you. Now I want to talk to the senior who is over these lines. Maybe you and your spouse worked your whole lives and saved responsibly, and now you look at every one of these lines and you are a few thousand over most of them. It feels like a punishment, but do not switch off because there is real money for you too. It is just in your taxes. Here are 3 moves that are built for exactly your situation. First, pension income splitting. If you have eligible pension income, you can move up to half of it on paper to your lower income spouse on Form T-1032. That one move can drop a household's tax bill by thousands of dollars a year and pull you back under that OAS clawback line. Second, the pension income amount, a federal credit on the first $2,000 of eligible pension income. Third, the age amount, a credit just for being 65 or older. With pension income splitting, moving that income onto the lower earning spouse's return means it is taxed far more gently and unlocks credits. For a couple in that position, that single move can be worth thousands a year for the rest of your lives. There are 2 more worth naming: the medical expense credit. Once your medical costs pass a certain slice of your income, the excess becomes a credit that comes straight off your tax. It covers prescriptions, dental work, glasses, hearing aids, and certain home modifications. And the disability tax credit, which can be backdated for up to 10 calendar years if you or your spouse has a lasting impairment. These are lines on the tax return that are yours to use. You were not forgotten. Your money is just filed under tax, not under benefit. Let me bring this all home. Every senior benefit in this country comes down to a line. Under $22,512, and the GIS is likely yours. Under $45,521, and the grocery credit is landing 4 times a year. Under $90,000, and the dental plan is helping on a sliding scale. Over $95,323, and the clawback is quietly at work. Between 60 and 64 and low income after a loss, and the allowance for the survivor may be sitting there unclaimed. And if you are over the lines, your money is in pension splitting, the pension amount and the age amount. That is the whole map. This is general education, not personal financial advice. The figures here are accurate as of the summer of 2026, but always confirm your numbers directly with Service Canada or the CRA before you act. If you know a senior who never knows if any of this applies to them, send them this video today. If this cleared things up for you, hit like and subscribe. At Smart Retirement, we break down exactly what Ottawa and the CRA are quietly doing with your money in plain English. No hype, no fear, just the numbers nobody else will say out loud. Tell me down in the comments, which of these 5 lines were you closest to? I read every single one. Take care of yourselves, grab that free 1-page cutoff sheet in the description, keep that tax return filed, and I will see you in the next.